variety of benefits for them, and the opportunity is there. So I've recently been seeing some borrowers actually, and we'll go into this in just a second, but 1031 exchange out of like a triplex and into a triple net lease. Now why they might do that? Well, you know, for this particular buyer who was our borrower, who was a pilot, you know, who flies from here to Australia every other day or every couple of days, dealing with tenants on a day-to-day basis just wasn't working for him. So getting into a T-Mobile property, triple net lease in Georgia, where, you know, now he just collects his mailbox money every month and he doesn't have to deal with any tenants, was much easier for him. So those are certainly opportunities with the existing commercial real estate owners. Those that are looking to 1031 exchange out and into a new type of property, or, you know, refinance opportunities as well. And the last would be, oh, here we go. So how do we find these opportunities? Those that are, you know, looking potentially refinance opportunities or 1031 exchange. So how do we see that someone already owns commercial real estate? Well, we're looking at 1040s all the time, every day. If we go to that line 8, that's going to take us to Schedule 1, and we see that additional income. We're going to go to that Schedule 1. That's going to take us to rental real estate, and we're going to go to Schedule E. That's going to take us here, and we're going to see that number 4 is always associated with a commercial property. So if you see the number 4, and you see that number 12, line 12, mortgage interest has a line there, then we know that there's interest on that. We know there's loan on that. We know there's debt on that property, and there's an opportunity to ask about the refinance or potential 1031 exchange. And the last would be business owners. Huge opportunity with business owners. If you have a business owner who's still renting the property that they operate out of, there's opportunities for them to go buy commercial real estate to operate their business out of with as little as 10% down through the SBA program. At the same time, there are projection-based SBA loans, and those are generally adjustable and tied to prime. So for those borrowers that get into those loans have 3-year prepayment penalties. So there's the opportunity to refinance out of those adjustable loans into permanent rate debt when that prepayment penalty is up. And we'll get into that specifically. But again, did you know that you can buy real estate for your business to operate out of with as little as 10% down? That is so incredibly powerful. You know, quickly start turning that rent into equity. And so how do we go find those opportunities? How do we find if a business is paying rent or leasing a property? Well, again, let's go back to the 1040, and we're going to go back to this Schedule 1 where we see there's income. And this time we're going to go to Schedule E, but instead of looking at that real estate, we're going to go here, we're going to see that there's actually business income. And then we're going to ask Mr. and Mrs. Client, can we see your 1120S? You know, we're dialing in all the financials, and we go to that 1120S, and there's rent. Well, Mr. and Mrs. Client, it looks like you're paying rent on the property that your business operates out of. Do you own that property? If not, did you know that you can buy a property with as little as 10% down? And for those business owners that have been operating in a property for 10, 20 years, generally the owners of that property, you know, they've built a relationship, and if that owner is going to sell, generally they're going to sell it to that owner. That owner's been there for so long. So that's an opportunity for how to find the rents. So let's talk about the 3 different types of owner-user financing. We talked about SBA, so there's 2 types of SBA loans. The original SBA 504 loan, which is 2 loans. So you have a first trust deed with a conventional lender. They lend up to 50% LTV. And then you have a second trust deed that's facilitated by a certified development company on behalf of the SBA, and they fund the additional 40% LTV to get you that 90% LTV. The downside of the SBA 504 loan is that second trust deed has a 10-year prepay. And the other downside is that these loans do take a little bit longer because you do have 2 institutions essentially underwriting them at the same time. But they are best for larger loans because the SBA fee is only based on the 40% that the SBA actually funds. And that'll make a little bit more sense as we go into the 7A product. The 7A product is a little bit more flexible. There's projection-based underwriting available. We can go to 85, 90% LTV. The benefit is that it does move a little bit quicker because you're only dealing with one lender. The SBA guarantees 75% of it, but they're not actually funding any of it. However, as a result of them guaranteeing 75% of the loan, the SBA fee is based on 75%. So you can see where, from a fee perspective, the 504, as you get into larger loan amounts, might make more sense. However, like I said on the 7A, it's a 3-year prepay. So for those borrowers that get in, you got 3 years to stabilize your cash flow on your business and then refinance out into permanent debt. But I think the biggest kind of what I use quite a bit on the 7A side is the projection-based underwriting. So, for instance, if we have a business owner that wants to buy a property, however, the cash flow of their business right now doesn't support the debt that they need to buy that property. However, as a result of moving into that property, it's larger, they're going to have more equipment, more efficiencies, more cash flow. We have lenders that will underwrite to those projections. Now, the pricing of those loans is commensurate with the level of risk. We're talking about projections. There's no guarantee of that. So those loans are generally adjustable, tied to prime. But again, you have that 3-year prepay. So you get 3 years, get into the property, get built out, get your cash flow up, and then refi out when the time comes. And lastly, we have owner-user conventional financing. And this is more for borrowers that don't need that leverage, right? If we don't need 85, 90% LTV, conventional owner-user is available, 75 to 80%. Structures are a little bit different, and fees vary because we're dealing just with a conventional lender at that point. But generally, I use that product, again, if it's a borrower that doesn't need the leverage, or if we're refinancing out of an SBA loan, those are great options. We talked about projection-based loans for those businesses that maybe don't have the cash flow today. That could be a startup situation. That could be a business that's moving to a larger location, and they're going to be able to, like I said, expand and grow as a result. Lenders will underwrite using these projections. They're tied to prime. They have a 3-year prepayment penalty, but again, that's opportunity in the future for another refinance when the time comes. One thing to keep in mind is that the way business owners, when they do own their property, that they operate out of, they generally own it in their name or an LLC, so you're not going to see that on the business tax return. So when you're seeing that rent, it could turn out that rent is ultimately just being paid back to them because they own the property. So you just have to go in and kind of have that conversation. But again, you can have that conversation just by seeing it on their 1040 and that Schedule E, and the fact that there's interest on that property, be it an investment property or a property that they operate their business out of. So let's get into a real deal that we put together. This is an SBA 7A loan, and let's just get into it. So a C2LO reached out to me and basically had a past client who had operated her family operated a cabinet supply company for like 25 years. And they had an opportunity to buy a property right down the street from where they've been operating for 15 years. It was kind of a perfect opportunity, already right in that area, so you're not kind of reestablishing yourself. And they had been going with another lender, and they got declined right at the last minute because of their inconsistent cash flow. Commercial loans are all cash flow based, and so what lenders look at is they're looking 3 years back, and they want to see a consistent upward trajectory, or at least consistency across the board. So when a borrower gets declined on an SBA loan, I think generally the thought is that they can't get an SBA loan anywhere, because the thought is that every SBA loan is the same, and that's just not the case. So she was, this borrower was getting along with a 7A and got declined from where they were at, and within a week of getting the financial package, I had them back in a process with another 7A loan with a different lender. But the difficulty with this loan and this deal was, number one, we're talking about a $540,000 purchase price, so kind of small on the commercial side. But more so is the fact that the business was operating as a sole proprietorship. So number one, they didn't maintain a balance sheet, and that's a requirement of the SBA. So we worked with the borrowers, we collected the year-end balance. There was no debt, so it's fairly easy to put together a balance sheet. But collecting the year-end bank statements and things to put together the balance sheet, and we were able to put those together for them. In addition to that, they were transitioning from their sole proprietorship into a layered partnership ownership structure throughout the transaction. So they went from the most simplistic ownership structure to probably the most complex, where they had a partnership that was owned by 3 S-corps, and each individual S-corp was owned by an owner of the business, which is much more complex than I generally see, especially for kind of a deal like this. But they were already kind of far along in putting that together, so that's the structure they wanted to move forward with. So the first thing I do is I'm dialing into the numbers, because ultimately that's going to tell me the story. So I immediately go to the tax returns, and I'm plugging in this data, and we're looking at the net operating cash flow. So that's the difference as it relates to residential DSCR loans. On the residential side, you can look at the gross rents and go to like a 1-to-1 ratio. On the commercial side, we look at the net operating income, and we want to see like a 1.25 debt service coverage. So it's not just enough to break even. Commercial lenders want to see that these properties and these businesses are profitable. And so if we look here, obviously I took the gross sales. I kind of simplified what we have here from the tax return, but taking the gross sales, cost of goods sold, gross profits, operating expenses, and ultimately getting to net income. But the important thing here is their debt payments, because that factors into cash flow. I can't just take the net operating cash flow from their tax returns. I got to throw in the debt that they have too. Now, fairly simple deal, no debt, so that took care of that. But as you can see, the net was kind of all over the place. And that's why the previous lender had issues with this deal. You're going from negative 235 in net operating to positive 410, down to 108, up to 246. So you can see, we're kind of all over the board. We're not super consistent. However, what do we need to see here? If we're all based on cash flow, we can generally back into the net operating income that we need to see. So if we're talking about 85% LTV, that's 459,000. If I'm just, assuming a 7A loan adjustable, we're just, I'm trying to give myself some flexibility here just to see on the high end what the NOI would need to be. So if we take 459,000 over 25 years at 10%, that's $41.71 a month. On an annual basis, that's $50,000 a year in principal and interest. If we're looking for a 1.25 debt service coverage, then we're looking for 50,000 times 1.25, which gets us to what we're looking for in an NOI, which is $62,000. Yes, it's been inconsistent, but if you look at 2021, we're at 9.24 times debt service. 2022, 3.33, 2023, 5.98. So yeah, 2020 wasn't all that great, but we're certainly, we have plenty of cash flow even though it's been consistent. So what do I need to find here? What are my hurdles? Number one, we have an established business, but the problem is we have inconsistent cash flow. However, it's been strong, so it's not a projection-based deal. So we're kind of in the middle ground here. No balance sheet, we'll have to create that, we can get around that. The small loan amount, again, a hurdle, but not terrible. What's our desired lender? We want 85% LTV, that's an SBA loan. We want a 7A loan because any 7A loan under $1 million has no guarantee fee, so that makes that loan fairly cheap. However, she doesn't need an adjustable loan because she's not projection based. So we need a fixed rate SBA 7A lender, which can be kind of difficult because fixed rate 7A loans are not sold on the open market like adjustable SBA loans are. So it's a bit of a niche lending market for these fixed SBA loans, especially for a loan of this size and the inconsistent cash flow. But we built a very deep bench of relationships over the last 5-10 years with lenders all over the country, and so I was able to identify a lender fairly quickly, within a week of collecting the financial package, and we were able to put together this deal for them. So we looked at cash flow based on a 10% rate, and we were able to lock them in at 7.15. So even less cash flow required for the loan that they needed. So we found this lender, put it together. It's a 25-year loan, fixed for the first 5 years at 7.15%. At the end of year 5, the rate will start adjusting, I believe on an annual basis based on prime plus 2. However, it's a 3-year prepay. So if we're fixed for 5 years at 7.25, at the end of 3 years, we're still at 7.15. We're still at 7.15 after 3 years. We can refinance at that time before it rolls adjustable. What were the next steps? So we got the LOI, we put together the deal, we presented the quote to the borrower, they said, let's go, we got to get moving. They'd already been declined, they were already behind the 8 ball a little bit, so we got my fee agreement signed. The fee agreement essentially protects all parties. We don't want to have a situation where we're disclosing the name of the lender and then all of a sudden this client's going right around us to the lender. So the fee agreement protects us from that standpoint. And we get that signed, we get the LOI from the lender, we get that signed by the client wires in the deposit, and then what we have is a kickoff call with my processor, and we go through all the details with the borrower, how the process is going to look from A to Z, and answer, of course, any questions. I mean, generally, we run it, hand in hand with our borrowers every step of the way, so they don't have a lot of communication with the lender throughout the process. We really facilitate that for them. So we assisted the borrower in creating those balance sheets. Like I said, they were operating as a sole proprietorship. Generally, they don't maintain balance sheets. We helped them, kind of structure the transition from the sole proprietorship to the layered limited partnership structure, and got that all together. And that created a lot of guarantors, right? So anyone with 20% or more ownership in the business has to guarantee the loan, and then all of those different entities, the layered partner, the overarching partnership entity, each S corp, and then each individual, and then any trusts as well. So there's quite a bit going on here for a relatively small loan, but this is how we move forward. One of the other issues that we ran into was the appraisal came in low on this. And so with an SBA 7A loan, you can go 85% without pledging additional collateral. And if you want to get to 90% LTV, they will go, most lenders will go there, but they'll put a lien on any additional collateral that's available. This particular lender, I think because of the size of the loan and a variety of other reasons, we're not comfortable going to 90%. So the borrower ended up coming in with the difference to get it closed.
They couldn't negotiate for the sales price?
No, we were going to contest the appraisal because everyone felt like it was low, but it was just not enough justification. And frankly, it was just dragging on, and the sellers were like, we need to get moving. And so what are our options at C2? I felt like when I joined C2 and I really got going with David, I was finding there was confusion within C2 as to what the options were, as to what LOs can do with commercial loans at C2. So let's get into it, and I'm going to make it very clear today. As we all know, historically, we can refer your clients to the commercial division. That's what I'm here for. I'm here as a resource for all the C2 LOs and their borrowers, and I'm here to jump on the phone, answer questions, go through scenarios, whatever it may be. But generally, everyone knows how this process works. You get paid. I think let's take a step back and remember the reason we started this division is because our LOs have clients coming to them saying, hey, you did just such a great job for me on my home loan. Can you help me with this commercial loan? And the answer was no, or go talk to this person, or whatever it was. But what was happening is those clients weren't coming back to the LOs. And so we built the division so the LOs had an internal platform where they could refer their clients with commercial needs to, get paid a referral fee, have a high level of execution, but most importantly, make sure those clients come back to them when they're done. And so that's generally how the division has operated by and large, and how most of the LOs leverage us. So we have three kind of situations here in terms of a referral fee. Relationship lead would be kind of a warm lead, someone you've done a loan for in the past. That's all commercial loans are an 80-20 split, and then on a relationship lead, that's a 25% referral fee from the 80%. But again, we take the client from A to Z, and again, make sure they come back to you when we're done. The other side would be a handoff cold lead. This is someone you've never talked to. You're kind of just passing them along, and it's sort of up to the division to build that relationship and make sure they come back to you. So we pay a 15% referral fee on that. And then if it's coming from an agent that you have a relationship with, or a referral partner that brings you leads and things of that nature, we fall in the middle at 20%. And that's right.
That was supposed to be 20.
That's right, 20 in the middle. So these are the property types. Multifamily, of course, 5 units or more, industrial and agriculture, special and mixed use. I've done churches, car washes, gas stations, residential care facilities. You name it, I've probably seen it and done it. Daycares, for sure, adult daycares, baby daycares, cannabis-related properties. I've done recording studios. You name it. Recycling companies. Triple net lease, of course, just really all across the board. And then from a loan perspective, of course, investor financing, that would be your triple net lease, multifamily, retail. We just went into owner user and conventional, but also access to agency, which would be your Fannie and Freddie. Bridge loans. Bridge loans in commercial are used to bridge the gap between a property that has insufficient cash flow and one that has sufficient cash flow. So if you're buying maybe a vacant property with 5 units and you're going to renovate it and turn it around and lease it up, you use a bridge loan. And bridge lenders are in the business of turning their money every 1 to 2 years. And so they give you leverage where the property doesn't support right now. And it's like 1 to 2 years interest only to give you the time to stabilize that property and then refinance out into perm debt. So that's what a bridge loan is used for in commercial. We have access to private money, of course, and then CMBS as well. We have a very deep bench of relationships with lenders all over the country: banks, credit unions, SBA lenders, Fannie, Freddie, Bridge, private money, and CMBS. How can you submit a loan inquiry to me, and how does it work? So you go right into, log into C2, click on commercial, click here to submit a commercial loan. Submit all the information. The information comes to me. I'll reach out to you. We'll discuss the opportunity and uncover anything that you know so far. And then ultimately I'll connect with the borrower and kind of walk them through the entire process, process the loan all the way through, and then get you paid a referral fee at the end. And of course, make sure they come back to you when we're done. Now, what's the other option for those C2 LOs that want to kind of cut their teeth on commercial? That is available to you. It's an 80-20 split on commercial loans, and we've built out a resource portal for the first time. And so for the first time, we have tools and resources and the requirements and all the things that you need to know to do a commercial loan at C2 are now available to you. And it's neat. We have a kind of a 3-step process on how we broker loans at C2 Commercial. There's some neat educational videos, some whiteboard videos that we put together. But here's the tools and resources. You can access needs lists. This will tell you exactly what you need to collect to get going on a investor deal or on a user deal, multifamily. We have sizers. These are super helpful. So if a borrower's like, oh, I have this property, what loan amount does it support, or do I qualify, or whatever it is, and you can come in here and simply plug in, this data, and it'll kind of spit out to you what the property can support. It's super helpful when your client just has a scenario they want to run through, or they're looking at property, and you can quickly kind of give them that information. And then the other one here is also a great tool. This compares, if someone wants to see all the options for an owner-user purchase. You have a business owner buying a property to operate their business out of. You can compare a 7A to a 504 to a conventional owner-user all in one spot, and it's a nice breakdown across the board. And lastly, that brings us to these beautiful items that we have in front of you on your table. For the first time, some fantastic commercial marketing materials. These are all going to be available on Canva through the platform that Perry was talking about earlier today. And you'll be able to plug your information in. I know for a long time, LOs have been asking for how do we, what can we put in front of our clients to identify these opportunities and let them know that we can help? Well, here we go. So you can get right in front of your business owners, turning rent into equity, the C2 commercial, and then also on the investor side, growing your portfolio. That's it for me today. I appreciate everyone's time and for being here. We've got Renee up next. She is going to be getting into the NAR lawsuit. I highly recommend sticking around for it. There's a ton of information there. But thank you so much, and happy to answer any questions.
So feedback, awesome. Second is next time, take a picture of your beautiful wife and your kid and say, I need loans. I need to feed them.
Can you stand up for everyone? We need loans. I need to feed this woman.
So,
not me, it's Carter that needs to be fed.
Yeah.
So you talked about purchases. What
Yeah.
about three years down the road after the prepays out about the refis?
Yeah.
Like just, is it kind of the same process, or are there different types of loans?
So at that point, so if we're 3 years into an SBA 7A loan and that prepay comes up, historically it has been difficult to refinance a 7A loan with another 7A loan. However, the SBA has recently come out with a new SOP and they've kind of opened that up a little bit, so that is an option. However, prior to that, what we almost always do at that point, because you're 3 years in, the loan's probably down, has been paid down, and hopefully the property's appreciated a bit to where you don't need a 7A, you don't need an SBA loan at all. You can go owner-user conventional.
Right.
So at that point, I'll refinance them out into an owner-user conventional. Those are generally fixed, similar to like an investor deal, fixed for the first 5, 7, 10 years, and a balloon loan. So for instance, I just got one quoted today, owner-user refinancing out of a 7A, and they're like 6.12 on a 10-year with no prepayment penalty.
What are the sources on those? Banks?
Banks, credit unions, all across the board. Yeah.
serious question.
Sure.
Not jokes. I've sent several people, you closed one or two,
Mhm.
maybe, I know one for sure.
Yeah.
For me, but I just sent another guy your way. Would you rather us go through and do the fact finding and stuff, or just send people your way and get out?
Up to you, whatever's best for you. I'm happy to do the fact finding on your behalf. If you obviously if you have data and you have that information, certainly I'm going to reach out to you for that to take it off the client's back. If you have documents that I need to collect and things like that, I'm certainly going to leverage you for that. But I always say it's to the extent that you want to be involved. Some LOs, they want to be on every email throughout the process, and there's ways we can accommodate that. And then some LOs, they just want to give my name. I get calls from clients that are like, oh, Shelly Heimer gave me your number and told me to call you. And then I just have that conversation and we just go with it. So I'm open to different options. I mean, certainly submitting a loan inquiry through the system allows you to, there's questions that are asked and it kind of gets more detail, but I'm open to different ways to do that. Yes?
So are these loans are tied into property or are they business loans?
Good question. So generally speaking, when we're talking about an SBA loan, there is real estate involved, but not always. I've done straight working capital loans with the SBA program. I've done business acquisitions that don't involve real estate. Those are generally 10-year loans. Now, there is one item that's sort of interesting that the SBA allows for. So if someone's buying a business and the real estate that business operates out of, if they were just to buy the business, it'd be a 10-year loan. If they were just to buy the real estate, it'd be a 25-year loan. However, if you buy both together and the real estate makes up the majority of the transaction, you can wrap that business component in with the real estate, and the business component gets the benefit of the 25-year loan. So you can wrap it all together.
And how many lenders do we have?
Good question. So yeah, that's the loaded question. So on the commercial side, you can work with any lender. You're not tied to the C2 approved list of lenders. You can work with any lender out there so long as it is on a commercial property. So all over the country, we have banks, credit unions, SBA lenders. So it's really, it's very deep venture lenders.
Okay, and just one last question. As far as training and becoming a loan officer with commercial, is it training, certification?
There's not. So this is we're trying to move in that direction. This resource portal is a step in that direction. I'm 1 to 1100, so I don't have the capacity to have a mentorship program or anything like that of that nature. But the majority of C2Os do leverage me as a referral platform, just from the sense of, look, I mean, the way I learned to do commercials, I sat in an office with that guy right behind you for 3 years. And just drank from the fire hose. Every email, every phone call, every meeting, everything. I mean, I was there at 6 o'clock in the morning, so by the time you got in, we could just start hammering away. And that's just how I learned everything. And so I always tell LOs, look, I get it. I mean, it's great to expand your knowledge base and things like that, but at the end of this 3-year period, we kind of looked at each other and we're like, this is really the only way you could successfully do this. And so what I tell LOs is, if you really want to get into the commercial side and that's what you want to sort of do, you're going to have to sort of step away from residential for a bit. Maybe not totally completely, but if you want to commit to commercial, that is what it takes.
Thanks.
Absolutely. Well, thank you so much. I appreciate everyone being here, and we have Renee coming up.